There's a rhythm to markets that most investors never notice until it's too late. Not the daily noise of headlines or the weekly swing of earnings reports, but something deeper, something that ticks along in the background like a metronome counting down to moments that reshape fortunes. If you know how to read these patterns, if you understand where we are in the larger cycles that govern market behavior, you can position yourself months or even years before the crowd realizes what's coming. And right now, as we move through late 2025, multiple historical patterns are pointing toward a specific window in 2027, particularly around March, that could mark one of the most significant inflection points in modern market history. The concept of an 18-month pattern isn't new. Market technicians have documented this cycle for decades, watching how markets move through predictable phases that roughly correspond to 18-month intervals. But what makes the 18 months leading to March 2027 particularly intriguing isn't just one cycle playing out, it's the convergence of multiple historical patterns, all pointing toward the same general time frame. When you layer the presidential election cycle on top of the 18.6-year real estate cycle, when you add in the traditional stock market patterns and the economic dynamics that have preceded every major market turning point in modern history, you start to see why March 2027 keeps appearing as a date that deserves serious attention. Let's start with the most immediate pattern, the one that's been documented in market data going back nearly a century. The presidential election cycle theory, first identified by Yale Hirsch in 1967, suggests that stock market returns follow a predictable pattern tied to the four-year presidential term. Historical data shows that markets tend to underperform in the first 2 years of a presidency, particularly in the second year, which coincides with midterm elections. But then something interesting happens. The 12 months following midterm elections have historically produced some of the strongest market returns of any period in the four-year cycle. Since 1962, the S&P 500 has averaged returns of over 16% in the year following midterm elections, compared to less than 1% in the year leading up to them. Donald Trump was inaugurated in January 2025, which means the midterm elections will take place in November 2026. If historical patterns hold, the period from November 2026 through November 2027 should represent the strongest phase of market performance in the entire presidential cycle. The third year of a presidential term, which in this case would be 2027, has historically been the best year for stock market performance, with average returns of over 17%, according to data going back to 1950. Research from Charles Schwab covering market data from 1933 to 2015 found that the third year of a presidential term consistently produces the strongest returns, regardless of which party controls the White House. The reasoning behind this pattern makes intuitive sense. In the first 2 years of a term, presidents focus on implementing their agenda, pushing through potentially controversial policies, dealing with the reality of governing rather than the promises of campaigning. Markets respond to this uncertainty with volatility and often underwhelming returns. Midterm elections typically result in the president's party losing seats in Congress, which historically has happened in all but 2 midterm elections since 1934, with the president's party losing an average of 28 House seats and 4 Senate seats. This creates gridlock, which might sound negative, but markets actually tend to welcome it. Gridlock means fewer dramatic policy changes, less regulatory uncertainty, more predictability. And as the president heads into year 3, with re-election on the horizon, there's tremendous political incentive to stimulate the economy, to make voters feel prosperous, to create the conditions that favor incumbents. But here's where March 2027 becomes particularly significant rather than just the general third-year effect. If we count 18 months forward from the midterm elections in November 2026, we arrive at May 2028. But markets don't move in neat calendar years. The strongest effects of the post-midterm bounce historically begin to show up within months of the election and build momentum through the following year. March 2027 sits roughly 16 months after the 2026 midterms, placing it right in the sweet spot of what historically has been the most powerful phase of the presidential cycle. Research analyzing 18-month periods before and after elections found that the 18 months following midterm elections significantly outperform 18-month periods with no elections. Now, let's add another layer to this analysis, one that relatively few investors pay attention to, but which has proven remarkably prescient at calling major market turning points. The 18.6-year real estate cycle, documented extensively by economist Fred Harrison, suggests that property markets, and by extension, the broader economy, move through predictable phases of boom, bust, and recovery that average out to roughly 18.5 years. Harrison isn't some fringe theorist. He accurately predicted the 1990 UK property crash and the 2008 financial crisis, both times years in advance, by following this cycle. The cycle works like this. After a major crash, markets take about 4 years to stabilize and begin recovering. This is followed by roughly 7 years of steady recovery, then a mid-cycle dip lasting a year or two, then another 7 years of more aggressive growth, culminating in what Harrison calls the winner's curse, a final 2-year period of euphoric price rises before the inevitable collapse. Harrison traces this pattern back 300 years in British property data, and has found similar patterns in the United States, Australia, and Japan. The last major property market peak occurred in late 2007, leading into the 2008 financial crisis. Add 18.6 years to that, and you land in mid-2026. Harrison has been explicit in his forecast, stating in multiple interviews that he expects property prices to peak in 2026, followed by a significant downturn. What makes this particularly relevant to March 2027 is the lag between property market peaks and broader economic or stock market consequences. In 2007, U.S. property prices peaked in mid-year, but the stock market didn't reach its peak until October 2007, and the real crisis didn't fully manifest until September 2008 when Lehman Brothers collapsed. There's always a delay between the moment real estate markets top out and the moment those stresses work their way through the financial system into visible crisis. Banks don't immediately recognize losses. Homeowners don't instantly default. The system has buffers and delays built in. If Harrison is correct and property markets peak in late 2026, then the period from early to mid-2027 would represent the window when those stresses begin manifesting in ways that impact broader asset markets. The mechanism behind the real estate cycle is worth understanding, because it explains why these patterns persist. Unlike most goods, where increased prices lead to increased supply which brings prices back down, real estate, and particularly land, operates differently. You can't manufacture more land in desirable locations. As property prices rise, existing landowners become wealthier on paper, which makes them more creditworthy, which allows them to borrow more, which they often invest in more property, which drives prices higher in a self-reinforcing cycle. Banks, seeing collateral values rising, become more willing to lend and often relax lending standards as competition for borrowers intensifies. Speculation increases as people who wouldn't normally invest in real estate jump in, not wanting to miss out on easy gains. This continues until something breaks, until prices reach levels that buyers literally cannot afford even with maximum leverage, until the first wave of over-leveraged investors starts defaulting, until banks tighten lending standards, until confidence evaporates. What's particularly concerning about the 2026 to 2027 timeframe is how it aligns with other stress points in the system. Commercial real estate in the United States is already showing significant weakness. Office vacancy rates have reached record highs in many markets as remote work permanently reduces demand for office space. Many commercial properties purchased with cheap debt during the low interest rate era of 2020 to 2021 are facing refinancing at dramatically higher rates. Small and medium-sized banks, which hold substantial commercial real estate loans, are particularly vulnerable. If residential real estate peaks in late 2026, as Harrison predicts, and commercial real estate continues deteriorating, the banking sector could face pressure from multiple directions simultaneously. There's another cycle worth considering, one that operates on a different timescale, but which may intersect with 2027 in meaningful ways. The 18-month stock market cycle, documented in technical analysis literature going back decades, describes a pattern where markets tend to complete significant swing cycles over periods of roughly 18 months. This doesn't mean markets crash every 18 months, rather it means that from major lows to major highs, or from major highs to major lows, the journey often takes somewhere in the neighborhood of 18 months. Research published in Technical Analysis, texts from the 1990s through the 2000s, demonstrated that this cycle produced remarkably regular fluctuations in markets, particularly during the 9-year period from March 1995 to March 2004. If we look at recent market history through this lens, patterns emerge. The stock market reached a significant low in October 2022 as the Federal Reserve aggressively raised interest rates to combat inflation. Add 18 months to October 2022 and you arrive at April 2024, which indeed marked a period where markets paused and consolidated after a strong rally. From that point, another 18 months forward brings us to October 2025 and then to April 2027. These cycles don't tick like clockwork. They're averages that shift based on the intensity of underlying trends and external events, but they provide a framework for understanding how market psychology and momentum tend to ebb and flow. The convergence of these cycles around 2026 and 2027 isn't coincidental. Economic cycles don't operate in isolation. Presidential administrations respond to economic conditions, which are themselves influenced by real estate markets, credit availability, and the accumulated effects of monetary policy decisions made years earlier. The Federal Reserve began raising interest rates aggressively in 2022, taking the federal funds rate from near zero to over 5% in roughly 18 months, the fastest rate hiking cycle in decades. Those rate increases work through the economy with long and variable lags, as economist Milton Friedman famously observed. The full effects of monetary tightening often don't manifest for 12 to 24 months. Higher rates first impact the most rate-sensitive sectors, then gradually work through consumer spending, business investment, and eventually employment. By late 2026 and early 2027, we'll be roughly 4 to 5 years out from the start of that hiking cycle, and roughly 3 years out from the peak in rates. That's historically right in the window when the cumulative effects of tight monetary policy have tended to produce visible economic stress. The yield curve, which inverted in 2022 and remained inverted through much of 2023, has historically preceded recessions with a lead time of 12 to 18 months. While the curve has since steepened as the Fed has begun cutting rates, the historical pattern suggests that the economic vulnerabilities created during the inversion period often don't fully resolve until well after the curve normalizes. There's a psychological dimension to these cycles that's worth understanding, particularly as it relates to 2027. Market cycles aren't just about economics and interest rates, they're about human nature, about the predictable ways that fear and greed drive investor behavior. In the early stages of a recovery from a crash, like the period from late 2022 through mid-2023, investors are cautious. They remember the pain of losses, they question whether the rally is real, they wait for confirmation. As the rally continues through 2024 and into 2025, confidence builds. The cautious investors who sat out the early gains start jumping in, not wanting to miss more upside. Media coverage becomes more bullish. Valuations expand as investors become willing to pay more for the same earnings because they are confident about the future. By the time you reach the late stages of a bull market, which if historical patterns hold would be late 2026 through early 2027, psychology has shifted dramatically. The investors who were cautious 2 years earlier are now fully invested. The skeptics have capitulated. Everyone has a story about someone who made money in stocks. Valuation concerns get dismissed with narratives about new eras and paradigm shifts. This is when markets are most vulnerable, not because some external shock arrives, but because there are simply no new buyers left. Everyone who is going to get in is already in. And when the last optimist has deployed their last dollar, the only direction left is down. Historical precedents show this pattern playing out repeatedly. In 2000, after years of relentless gains in technology stocks, the Nasdaq peaked in March and then collapsed over the next 2.5 years. In 2007, after years of rising home prices and booming credit markets, stocks peaked in October and then declined for 17 months. In both cases, the peaks didn't arrive randomly. They came after extended periods of rising prices, after valuation metrics had reached extremes, after skeptics had been proven wrong so many times that skepticism itself seemed foolish. The 2007 peak came in the third year of George W. Bush's second term, exactly when the presidential cycle would have predicted strong performance. Markets did perform strongly through most of 2007, right up until the moment they didn't. This raises an important question about March 2027 specifically. Why that month rather than December 2026 or June 2027? The honest answer is that pinpointing exact months is more art than science. Markets don't follow calendars with perfect precision, but March has historically been a significant month for market turning points. March 1995 marked the beginning of an 18-month cycle that launched the great technology bull market. March 2004 marked another major cycle point. March 2020 saw one of the sharpest market declines in history as COVID panic set in, followed by one of the fastest recoveries. There's something about the first quarter of the year, after holiday seasonal patterns have played out, after companies have reported fourth quarter earnings, after investors have had time to assess the year ahead, that tends to produce important inflection points. Moreover, March 2027 sits at the intersection of several key events and cycles. It comes roughly 16 months after the 2026 midterm elections, right in the historically strong post-midterm period. It comes roughly 18 months after Fred Harrison's predicted 2026 property market peak, which is about the lag time we saw between the 2007 property peak and the visible 2008 crisis. It comes about 26 months into Trump's presidency, placing it firmly in year 3 when presidential incentives to stimulate the economy are strongest. And it comes at a point where the lagged effects of past monetary policy decisions should be fully working through the system. The economic backdrop leading into this period will be crucial to watch. One of the challenges in predicting market turning points is that markets don't crash in isolation. They crash when economic conditions deteriorate enough that corporate earnings disappoint, when credit conditions tighten, when unemployment rises, when consumers pull back. Right now, in late 2025, the economy remains relatively healthy by most traditional measures. Unemployment is still near historic lows. Corporate earnings have been solid. Consumer spending continues. But historical patterns suggest that these conditions typically persist right up until the moment they don't, and then they deteriorate rapidly. The labor market in particular tends to move from seemingly fine to clearly weak in a matter of months, not years. One indicator worth monitoring closely is the temporary employment sector. Research from the Federal Reserve Bank of Philadelphia found that temporary help employment leads total employment by 3 to 6 months and has preceded all recessions since 1990. Companies cut temporary workers first when they sense weakness coming, well before they start laying off permanent staff. If temporary employment starts declining significantly in late 2026, that would be a warning sign that the labor market strength we see today may not persist into spring 2027. Similarly, the Conference Board's leading economic index, which is designed to predict turning points in the economy 7 months in advance, would potentially start showing weakness in late 2026 if a downturn were coming in early to mid-2027. Market breadth indicators offer another window into potential trouble ahead. In healthy bull markets, the broad market participates in gains. Most stocks make new highs along with the major indices. But in the final stages of bull markets, leadership narrows. The indices might continue rising, driven by a small number of large companies, while the majority of stocks stagnate or decline. This is exactly what we've seen in recent months, with the so-called Magnificent Seven technology stocks accounting for a disproportionate share of market gains, while mid-cap and small-cap stocks have lagged. Research from the Lloydhold Group shows that market breadth typically deteriorates 3 to 6 months before major market tops, with fewer than 40% of stocks trading above their 200-day moving averages being a particularly concerning signal. The Buffett indicator, which compares total stock market capitalization to GDP, has recently surpassed its pandemic-era record levels. The indicator now shows the stock market at more than twice the size of the economy, even after GDP growth has been solid. While this metric isn't perfect, particularly given how much of the S&P 500's market cap now comes from technology companies with global revenue streams, it does suggest that stocks are priced for near-perfect outcomes. When markets are priced for perfection, there's very little room for disappointment. Any surprise, any unexpected weakness in earnings or economic growth can trigger disproportionate selling as investors realize they paid too much for assets whose prospects weren't quite as rosy as anticipated. The bond market is sending mixed signals. The yield curve, after being inverted for much of 2023, has steepened as the Federal Reserve has begun cutting short-term rates. This steepening is typical in the late stages of a hiking cycle and doesn't necessarily signal imminent recession. However, history shows that some of the worst market declines have occurred after the yield curve uninverts, as was the case in 2007. The inversion itself signals that recession is coming, but the steepening sometimes marks the point when that recession is actually beginning. The timing of this dynamic will be crucial to watch as we move through 2026. If the curve continues steepening while economic data weakens, that would be consistent with the pattern seen before past recessions. Geopolitical factors add another layer of uncertainty. The Trump administration has signaled intentions to implement significant tariffs, particularly on Chinese goods. While tariffs themselves don't necessarily crash markets, they do create inflation pressure and supply chain disruptions that can weigh on corporate earnings. More broadly, the state of U.S.-China relations, the ongoing conflict in Ukraine, Middle East tensions, and other geopolitical flashpoints could serve as triggers for market volatility, even if the underlying cycle patterns were pointing toward stability. Markets that are technically vulnerable, where valuations are extended and breadth is weak, tend to be more sensitive to external shocks than markets that are technically healthy. The housing market deserves particular attention as we move through 2026. Mortgage rates, after spiking above 7% in 2023, have moderated somewhat, but remain elevated by historical standards. This has created a situation where existing homeowners with mortgages locked in at 3% or less during the pandemic are extremely reluctant to sell and trade up to new homes with mortgages at 6% or higher. This lock-in effect has constrained housing supply, which has helped support prices despite affordability being at some of the worst levels in decades. If Fred Harrison is correct and this dynamic reaches a breaking point in 2026, the mechanism would likely involve either a significant increase in distressed selling, perhaps as economic conditions weaken and unemployment rises, or a shift in buyer psychology where people stop believing that prices will always go up. What's interesting about real estate peaks is that they don't always look like peaks at the time. In 2005 and 2006, as home prices reached unsustainable levels, the narrative was that America simply wasn't making enough land, that immigration and population growth would support prices forever, that real estate was a safe investment because everyone needs a place to live. Those narratives weren't entirely wrong, but they missed the crucial point that markets can remain overvalued far longer than people expect, and then correct far more violently than people imagine possible. If we're in a similar psychological state in late 2026, with most market participants convinced that housing weakness is impossible, or that the government will always step in to support prices, that would actually be evidence that we're closer to a peak rather than further from one. The policy response to any market stress that emerges in late 2026 or early 2027 will be crucial. The Federal Reserve has already begun cutting rates, reversing the aggressive tightening of 2022 and 2023. This gives them some ammunition to respond if economic conditions weaken. However, unlike the 2008 crisis when the Fed had significant room to cut rates from over 5%, or the 2020 pandemic when they had room to cut from 2.5%, the current starting point for any crisis would be with rates already lowered from their peak. The Fed's balance sheet, while smaller than its pandemic peak, remains much larger than it was before 2008. This limits their ability to deploy quantitative easing on the scale they did in past crises. Fiscal policy options are even more constrained. The U.S. federal debt has ballooned to levels not seen since World War II, now exceeding 100% of GDP. This limits the government's ability to respond to a crisis with massive stimulus spending, as they did in 2008 and 2020. Any stimulus would add to already enormous deficits, potentially spooking bond markets and driving up long-term interest rates, even as the Fed tries to cut short-term rates. This creates a dilemma. If markets begin experiencing stress in early 2027, policymakers would face difficult choices. Aggressive intervention might stabilize markets temporarily, but could exacerbate long-term debt sustainability concerns. Limited intervention might lead to deeper market declines, but could allow for a healthier long-term reset of valuations and debt levels. One factor that could accelerate any decline is the structure of modern markets. The rise of passive investing through index funds and ETFs means that a much larger share of daily trading volume now comes from flows that don't discriminate between companies. When investors sell an S&P 500 index fund, they're selling all 500 companies proportionally, regardless of individual company fundamentals. This can amplify market moves in both directions. Similarly, the growth of algorithmic trading and the tightening of correlation between asset classes means that selling pressure can cascade across markets faster than in past eras. The speed of the March 2020 decline, where markets fell over 30% in roughly 3 weeks, demonstrated how quickly modern market structure can amplify moves. Looking at historical analogs, the March 2027 timeframe would sit in a similar position relative to the presidential cycle as October 2007 did in George W. Bush's second term. Both mark points late in the third year of a president's term, when markets had performed strongly but were showing signs of excess. The 2007 market peaked and then began a decline that accelerated dramatically in 2008. If history were to rhyme rather than repeat exactly, we might see a peak in late 2026 or early 2027, followed by initial declines that then accelerate as the underlying economic weaknesses become apparent through late 2027 and into 2028. This pattern would align with both the presidential cycle dynamics, where year one of a new term tends to be weak for markets, and with the real estate cycle dynamics, where the bust phase following a peak typically lasts several years. The March 2000 timeframe in the Clinton administration offers another parallel. That peak came late in Clinton's second term during a period of intense optimism about technology and the new economy. Markets had risen relentlessly for years, dismissing concerns about valuations with narratives about how everything had changed. The peak came in March, followed by a grinding decline that lasted 2.5 years and took the Nasdaq down over 70%. The parallel to today isn't exact. Technology is more profitable now than it was in 2000, but the psychological dynamics of late-stage bull markets are similar. Extended periods of gains breed complacency and justify higher valuations until something shifts, often for reasons that seem obvious only in retrospect. What makes the 2027 situation potentially more complex than past cycles is the layering of multiple crises from recent years. We're not fully recovered from the pandemic's economic disruptions. Supply chains have normalized but remain more fragile than pre-pandemic. The commercial real estate sector is still adjusting to permanently reduced demand for office space. Regional banking stress that emerged in early 2023 with the failures of Silicon Valley Bank and others has been contained but not fully resolved. The geopolitical environment is more unstable than at any time since the Cold War. These aren't immediate crisis-level problems, but they represent underlying vulnerabilities that could amplify the effects of whatever trigger eventually pushes markets lower. For investors and traders trying to position for this potential turning point, the key is recognizing that precision is impossible. Trying to sell on the exact day of a market peak is like trying to catch lightning in a bottle. Markets don't ring a bell at tops or bottoms. What historical patterns can provide is a framework for understanding when the risk-reward setup shifts from favorable to unfavorable. If the third year of a presidential term has historically been the strongest, but has also occasionally marked major peaks, And if we're entering that third year with valuations elevated, breadth weak, and multiple cycle patterns converging, then the prudent approach might be to reduce exposure to the most speculative parts of the market, even if that means potentially missing the final surge higher. The indicators to watch closely as we move through late 2026 and into 2027 will be those that have historically given advance warning of turning points. Leading economic indicators from the Conference Board, temporary employment trends, credit spreads, particularly the spread between junk bonds and treasuries, market breadth measures, and the behavior of traditionally defensive sectors like utilities and consumer staples. When markets are healthy, risky assets outperform safe assets. When markets are topping, smart money begins rotating into safer assets before the broader market recognizes the change. If by early 2027 we're seeing defensives outperforming even as major indices continue rising, that divergence would be noteworthy. The narrative around artificial intelligence adds an interesting wrinkle to this analysis. Much of the market strength in 2024 and 2025 has been driven by enthusiasm about AI's transformative potential. The comparison to past technology bubbles is inevitable, but may not be entirely fair. The companies leading today's AI boom, firms like Microsoft, Google, Amazon, and NVIDIA, are massively profitable businesses with established market positions, unlike many of the money-losing startups that led the dot-com bubble. However, the valuations being assigned to these companies increasingly depend on AI delivering truly transformative productivity gains across the economy. If by late 2026 or early 2027 the evidence for those gains remains more promise than reality, or if competition begins eroding the profit margins that investors expect these companies to sustain, sentiment could shift quickly. It's worth emphasizing that these cycle patterns don't guarantee that markets will peak in March 2027 or even that year. Cycles are probabilistic, not deterministic. They describe what has tended to happen on average, but allow for significant variation in any individual instance. The presidential cycle has been less reliable in recent decades than it was historically, particularly the weakness in year 1 and 2 that the theory predicts. The 18.6-year real estate cycle has been disrupted by events like world wars in the past, and could theoretically be disrupted by policy interventions or demographic shifts this time. The 18-month stock market cycle sometimes extends to 20 months or contracts to 15, depending on the strength of underlying trends. What the convergence of patterns does suggest is that the 2026 to 2027 timeframe represents a period of elevated risk when conditions favorable for market tops will exist. Whether those conditions actually produce a top depends on how economic fundamentals evolve, how policy decisions play out, how global events unfold, and ultimately how investor psychology shifts. Markets are complex adaptive systems where countless variables interact in ways that can never be fully predicted. The value of cycle analysis isn't in providing precise forecasts, but in offering a framework for thinking about probabilities and managing risk accordingly. For individuals planning major financial decisions like retirement, the implications of this analysis should be considered carefully. If you're someone who plans to retire in 2027, counting on portfolio values continuing to rise through that year involves taking on meaningful risk based on historical patterns. If you're someone accumulating assets for retirement decades away, market volatility in 2027 would represent an opportunity rather than a threat. The appropriate response to cycle analysis depends entirely on your personal timeline and risk tolerance. What's crucial is making those decisions with eyes open to what history suggests about the sustainability of current market levels, rather than simply extrapolating recent gains indefinitely into the future. The psychological challenge for investors as we approach these potential turning points is that human nature makes us terrible at recognizing tops in real time. When markets have been rising for years, when your portfolio shows strong gains, when every dip has been a buying opportunity, it becomes almost impossible to imagine that this time might be different, that the next dip might not bounce, that the bull market might actually be ending. The investors who successfully navigated past market tops weren't necessarily smarter than everyone else. They were more disciplined about following frameworks that helped them overcome the psychological biases that caused most people to stay too long at the party. Understanding cycle patterns provides that framework, a reason to reduce risk even when it feels uncomfortable to do so, because everything in the market is telling you to stay invested. If March 2027 does mark a significant turning point, the period we're living through right now in late 2025 will look in retrospect like the calm before the storm. Markets are still relatively stable. Economic data remains mostly positive. Investor sentiment is constructive, but not yet euphoric. This is exactly the environment that historically exists 12 to 18 months before major tops. The extreme optimism and speculation that mark the final phase typically emerge in the last few months before a peak, as those who have been cautious finally capitulate, and as new investors attracted by stories of easy money pile in. If we see that kind of behavior developing through late 2026, it would be consistent with the cycles pointing toward a 2027 turning point. The information presented here represents historical patterns and cycle analysis, not investment advice or guaranteed predictions. Markets are influenced by countless factors, and past patterns don't always repeat. But what history does teach us is that markets are cyclical, that periods of strength are eventually followed by periods of weakness, and that understanding where we are in these larger cycles can inform better decision-making. As multiple historical patterns converge around the 2026 to 2027 timeframe, as we enter the traditionally strongest but also potentially most vulnerable phase of the presidential cycle, as real estate cycle theory suggests, we're approaching a peak, and as market valuations reach levels that have historically preceded corrections, the prudent approach is to pay attention, to monitor the indicators that have warned of past turning points, and to position accordingly. The 18-month pattern isn't just about counting months forward from some starting point. It's about understanding that market cycles operate on multiple timescales simultaneously. And when those cycles align, when the monthly cycles synchronize with the presidential cycles, with the real estate cycles, with the economic cycles, the probability of significant market changes increases. March 2027 sits at one of those convergence points, a date that emerges not from any single analysis, but from the layering of multiple independent frameworks that all point toward the same general window. Whether that convergence produces the market top that history suggests is possible depends on variables that won't be knowable until events unfold. But having that date marked on the calendar, understanding why it matters, and watching for the warning signs that would confirm or contradict the historical patterns gives you a framework that most investors won't have. And in markets where information advantages are increasingly rare, that framework might be the most valuable asset you possess. If you found this analysis valuable, if it changed how you think about market timing and the patterns that govern market behavior, then make sure you like this video and subscribe to the channel. Because understanding how these cycles work, how to read the signals that markets send before major turning points, and how to position your portfolio based on historical patterns rather than headlines, is exactly what we cover here. The crowd will recognize what happened in 2027 after it happens. You'll have seen it coming months or even years in advance, because you understood the patterns, you read the cycles, and you knew that in markets, timing isn't everything, but understanding time is.